Hey, Chris Camburn here, March 26, 2025. And I thought I'd make a video for how much cash should I hold? You get a lot of questions of, when you're approaching retirement, actually, even when you're starting out, how much cash should you have? But more especially when you're entering retirement, how much cash should you hold since the stock market will go up and down and volatility creates some problems. So let's run some disclosures and I'll get into my thoughts on how much cash you should hold. What I thought I'd do is let me share my um, presentation for today here. The bullet points. I thought first I'd start with why not hold cash, right? So why have any cash? We'll talk about the accumulation phase, upcoming expenses, and then how much cash should I hold? And depending upon how aggressive or conservative you are, I've seen answers. I've seen people hold 10 years worth of spending money as cash. Now, what does that translate to your asset allocation? I really don't create asset allocations based upon your standard 60-40 or something like that when it comes to conservative people. So if you're looking up how much cash should you hold, more than likely you're conservative. You might be aggressive and just curious. And then I'll discuss cash versus bonds. Well, should I invest in bonds instead of cash? And we'll talk about how soundbite is. I have some other videos. The more volatile asset class will underperform. How do I say this? If it's a tortoise and a hare, speaking metaphorically, the tortoise will outperform when the hare underperforms. So tortoises don't win because they outperform. Tortoises win because hares underperform. So I'll kind of show that and then talk about some risks with cash. Money. Cash today will be, my proxy for cash is money market funds. So it is possible to lose money in money market funds. And I'll just talk about that, but they're highly predictable and pretty safe. So let's start with staying true to my presentation here. Let's talk about why not hold cash. And I use Portfolio Visualizer for these analyses because they give broad asset class consideration. So I've created 3 portfolios, one of which is all cash, one of which is the total bond market, and one of which is the total U.S. stock market, right? So 3 portfolios. And the data is from January of 1987 to February of 2025. I mean, a sufficient enough time. I have some manual spreadsheets. I'll also show you where the data is 10 years of cash. This happens to have a lot longer, but I have some additional insight into these suggestions. So first of all, why not hold cash? I mean, over this period of time, $1 million of cash came to almost 3.2, whereby bonds is 6.5 million and stocks is 50 million. So from 1 million to 50 million in stocks. So for the reason of why not to hold cash, the longer you do, the less returns you have, or the longer you hold stocks or bonds, the higher your probability of success, the more likely your rate of success, and more than likely, the better your returns are over cash. So for long periods of time, why hold cash? Well, why not hold cash is you might just do better in something else. But that was a 50-year period, right? And so why not hold cash is for the long term. But then and so if you're in I guess I should talk about that then. Why not hold cash? Is if you're in the accumulation phase of your life, if you're working and earning and saving on a monthly basis and you don't have concerns about your job, why hold any cash? Just put your money out there and let it ride and invest. And, I'm also speaking to someone who, if you have no money saved, well, even if you have no money saved, just starting out, if your job's secure, I'm more aggressive on that end. Just start investing into an index fund. Get your money growing. The only reason why you would not do that is if you had a concern about your job prior to having some amount of money saved, or unless you had a known upcoming expense. You want to do something to the house. You want to buy a car for cash and not finance it. You have to pay some kind of bill. I don't know. You just have an upcoming expense. I mean, it's March. If I was going to buy something in September, I might not. I might earmark a little bit of money each month to buy what I'm thinking of, or maybe I wouldn't commit it to investments. I'd just leave it in the bank until I had the monies necessary for that particular expense. So if you have a known expense coming up, I wouldn't invest that money. A known expense. By the way, it's like, yeah, I'm just saving money on a monthly basis. I really don't have any big expenses to come up. I'm super aggressive in that regard. Just getting your money into a growth fund and let's get it going. But there becomes a tipping point, and the tipping point is when you hit the withdrawal phase, and that means you're about to retire or you have retired. You're right at that point when, or even you're in retirement. So when you're with retirement in sight, now my answer changes. Now my answer becomes anywhere from no cash, if you just want to play the 4% withdrawal game, up to what I'd say 10 years of spending money. And so if you think about your monthly expenses, if you're going to spend $8,000 a month, just using a common number I have here, $8,000 a month is $96,000 a year. So anywhere from zero or 1 year, $96,000, which is call it $100,000. $100,000 for every year that you want to be conservative. And I have some people who have 10 years of money in cash. What that allows them to do is let the other part of their investments ride in growth funds and stock funds, such that as the stock market ebbs and flows, they have confidence that they're going to have spending money every year. And they know for the next 10 years, even if there's a massive hiccup in the markets, that they still have money saved in savings, in money market funds that they can withdraw from every single month without more than likely not losing money. And let's get into that chart a little bit. These are the annual returns of stocks, bonds, and cash. So cash is blue, bonds are green, and stocks are this grayish color. So blue, if you look across this, let me get that darn image off of there, but if you look across here, you'll see that cash never really seems to go below the 0% line. Bonds do. Here in 1994, bonds lost money. I know the years, 94, 99, 2013, 2021, 2022. Bonds lost money in those 5 or 6 years. Cash did not, and stocks have lost money in 90, 2000, 2001, 2002, 2008, 2018, 2022, more times than bonds, right? So on an annual basis, stocks and bonds can lose money. Over time, they have pretty positive success, meaning if you look at this chart for annual, I guess there's something in here that has rolling returns, right? This is a great, okay, my head's out of the way. I'm here at rolling returns. This is great for cash for 1 year, 3 year, 5, 7, 10, 15 years. Rolling returns have been, on average, 2.5 to 3% over most periods. I mean, that's called very low volatility and very low standard deviation, very high predictability of results. Bonds have averaged in the 5s. That's quite interesting. For 1, 3, 5, 7, and 10 years, bonds have averaged in the 5s for all of those periods. But if you look, the highs have been super, 18% a year, in some particular for bonds is great, but a low of negative 15. So it shows a little bit of the volatility of bonds. Even bonds, I know I have stats that show where bonds have not lost money over a 10-year period of time, just as this shows, but anywhere in between, well, I can't quite highlight that, but in the mid-ranges, 3, 5, 7 years, bonds have shown a loss of money. So here's 7 years of cash. The worst has been 0.08%, so essentially nothing, right? I think that equates to $800 on $100,000 after 7 years. And but bonds as a comparison, lost money over some 7-year period, such that there was a time, and I'll show you this on another chart, where cash was a better idea. And then stocks, stocks had the most volatility. Certainly 1 year, a best year for stocks in this time period was 62, but the worst was 43. And so if you're leaning towards the conservative side as you approach retirement, this it kind of validates my suggestion of 0 to 10 years. Maybe I'll change my approach to 0 to 7 years. But I digress because, when you have someone sitting in front of you who says, Chris, I'm conservative. I don't like losses. I don't want to lose money. I don't want to not have money to spend. There's economics and there's emotions. And so I can show you economically how cash may lose to inflation, and so you won't lose in principal, but you lose in purchasing power. But people would rather, if I said, would you rather lose your principal or would you rather lose your purchasing power? It's going to be a mixed bag of answers I get, and I have to respect the answer of the person that's providing it. So if someone says, Chris, I just don't want to lose my principal, I'll just spend less in the future, or I'll buy less things. Okay, I have to respect that and now put together a portfolio that helps accommodate that person's investment objective. So, this is why up to 10 years of cash, I wouldn't bat an eye, and I have people doing it. They just don't want to lose money, and it's been proven that at times bonds have lost money over a 7-year period, 5-year period, 3 and 1 year period. Now, I will digress. I will confess that's because of the sharp rise in interest rates we've had recently. And that's what happened in 94 and 99. There were spikes in interest rates, which quickly came down. So from this point forward, I'd say it's less likely for bonds to have positive results over the next 1, 3, 5, 7 years. It's more likely to have positive results than negative results unless interest rates go up again, which no one's talking about right now, but who knows what's going to happen. So these are rolling 3-year returns. And let's just look at this. This is the rolling 3 years of cash, stocks, and bonds. Again, cash has the most volatile rolling 3 years. Bonds are green, a little less volatile. And bonds do tip, just to show you here, this right here is 0%. I can't quite highlight that. Get this. Let me just get the screen. Try to get everything on the screen here. Oh gosh, I hope you can see that. Gosh, that's small. Here's what I'll do. Let me get out of here. All right, and so here's the 0 line right here, right? This is the 0 line of negative returns, and you'll see cash, the dark blue, never really gets, it gets low, but it never goes below the 0 line. Yet bonds here on a rolling, bonds is the green. You can see here in 2022, 3, 4, we kind of crossed the line for bonds on a rolling 3-year number being negative. All right, and then for a rolling 5-year, again, the most recent years, somewhere in 22, and then for 23 and 24, the rolling 5-year returns on bonds has been negative, whereby for cash, it's still positive. For stocks for this period of time, the most recent 5 years, it's positive, but bonds have been negative. All right, so that's kind of the last there. So let me switch to some of my data, just talk about some data I have here for a little bit. Let me just change screens. All right, here's some of my cash stock bond data. Now let me go through this for you. I have time periods of rolling 1-year stock returns versus rolling 1-year bond returns. 1 year, if I said stocks, I apologize. Let me say that again. 1 year rolling cash returns versus 1 year rolling bond returns. Cash is green, bonds are purple, right? So I love Excel. When you do these spreadsheets, it gives you all these colors and makes it a little bit fun sometimes and easier, but then sometimes you have to customize it. But here we go. So the green is 1 year rolling cash returns for a period of 10 years. And the rolling bond returns are purple. You can see here's the 0 line. I have to find a way to highlight 0% better for these videos, but This is the 0%. That didn't help. This is the 0% line. Are we ahead of zero or have we lost money? Again, cash here never goes below the zero line. Bonds have at different periods of time. That's rolling 1 year. Let's look at rolling 3 year, right? Very similar to what we saw through Portfolio Visualizer. Cash has not been negative for any rolling 3 year in the past 10 years. Bonds have, and here somewhere in about March of 2022, 3 years ago, bonds went negative on the rolling 3 year and didn't come back to positive until earlier this year. How about for a 5 year number? If there's any differences between my information and Portfolio Visualizer, it's negligible, but I also know that my data is 10 years up until yesterday, March 25th. Portfolio Visualizer was through the end of 2024. So if you're seeing some anomaly there, it's negligible only because of a 3-month data difference, data time period difference, or measuring period difference. So again, for the past 5 years, bonds have just gotten back to positive after dipping negative a few times on a rolling 5 year number. Then what I do is I chart the difference. Let's call it the difference. So if you stay in cash over bonds, there have been times, we need to focus on the secondary axis here. Here's the 0 mark. So cash better than bonds. So if it's ahead of 0, cash has been the better asset class for the time period. If it's below 0, bonds, because it's cash minus bonds. Bonds were better, higher than cash, so it's a negative number. So right in this period, bonds clearly superior. How do I zoom in on this a little bit for these dates? I feel like there's too many dates there at the bottom for you, but you can see here for a 1 year period, here's the 0 line right about here, where cash had been better than bonds for a rolling 1 year period a handful of times in the early 2020s. Let's look at a 3 year period. Again, cash, it seems like from 2018 just until 2022, bonds have been doing better. But since 2022, again, it's the increase in rates. From here forward, cash has been the better investment for a rolling 3 year because it's ahead of the 0 line. Let's look at 5. And again, it's most recently, if we call it here, starting in early to mid 2022, cash became the better investment. Looking back 5 years, cash has been better than bonds. Not common that this happens. Again, the raise of interest rates is what caused this, but it makes you consider like, hey, maybe cash is something I should have in my portfolio because low returns are better than negative returns. And to my point here of the soundbite being cash will outperform bonds when bonds underperform cash. So cash doesn't win just because it's awesome. Cash wins when bonds are lousy. So what is a striking chart here? This is the 5 year difference of cash to bonds. And then let's look at the 5 year bond returns. I mean, just the complete opposite. Look at this, the complete opposite. It's because bonds have done so poorly that cash shows better. All right, so this is absolute bond returns over cash minus bond returns. I mean, it's almost a mirror image. Let's look for that for 3 years. 3 year bond returns plotted against the difference of cash over bonds. So again, here's the 0 line on the right. Well, I guess this one's plotting me to the left. I don't know. But it's showing that when bonds gets below 0, cash starts to outperform. And then also for 5 years. Again, when, 5-year bond. When bond actual returns get bad, the brown line, the delta, the cash out performance gets magnified. So it's not that cash outperforms bonds because it's good. Cash outperforms bonds because bonds are bad. Now, one last point to make. So, it's not that money market funds are without risk. Money market funds they're investments, they're securities. The money market fund manager goes out and buys bonds from the government, from corporations, government agencies, and they buy such short-term bonds that they can manage the volatility to a price of $1 per share. However, how a money market fund can lose money is if enough of the issuers in the money market fund if they default. So if you had 100 bonds in a money market fund, each at a 1% weight, and if one of the issuer goes out of business unexpectedly, just think of just a bankruptcy that comes out of nowhere. Theoretically, if one issuer loses and defaults and the bonds are worthless, now your 100% becomes 99% and you've lost 1% of your money. So that is possible. And what happened, we did have a period of time in history where, let me just switch the screen to what I Googled was, I knew the answer was out there. And so I knew to Google, has a money market fund ever lost money? And what Investopedia came up with was money market mayhem, the reserve fund meltdown. And, I was in practice, I remember this. In 2008, the reserve primary fund, which is no longer in existence, so it's not something you can buy. So, I can't talk about funds that I can help you buy, but I think I can talk about funds that you simply can't buy or, have closed up shop or no longer available. So a money market fund named the Reserve Primary Fund broke the buck. That money market funds are generated $1 per share. It went to 99 cents a share. Or less. This thing says fell below $1 per share. I don't remember if it lost a penny or 2 pennies. It was like absolutely amazing, but the reason for it was the fund had some commercial paper by Lehman Brothers, and it held 1.5% of its assets in Lehman commercial paper. So maybe on its own, the fund could have withheld its NAV, just reduced its yield. But because everyone knew that there was some Lehman Brothers paper in this fund, it was just everyone called for redemptions. And because the fund had to liquidate so much in assets, they had to reduce their price. So I'll put a link to this Investopedia article here in the description. But just know, money market funds are not guaranteed like a bank account. But traditionally, over time, they'll help you earn more interest than a bank account will. And ways that the industry now handles or has addressed the risk of another kind of run on the fund is they've imposed gate fees. So what I tell clients with money market funds is, if it hits the fan again, so to speak, chances are the fund won't reduce its net asset value to 99 cents or 98 cents. If there's a run on the fund, what they'll do is they'll maintain a $1 a share price, but they'll impose a gate fee. They have gate fees now. It's in the prospectus. You can read it. And the gate fee can be 1 or 2%. What that means is if you leave the fund under extraordinary circumstances, and for every dollar you take out, they'll take a 1%, or for any withdrawal, they'll withhold 1 or 2% as a fee for leaving during tough times, which is sort of bogus because you might need your money in tough times, but that's just how they've addressed the risk. And so I guess it's kind of fair. It's people who are going to bail on the fund and leave are kind of getting penalized, so that people who are still in the fund do not get penalized. It's sort of like I guess it's a fair approach, but I don't want to belabor it too much. The point is that money market funds are not without their risk. There has been a fund that has lost money, but using a money market fund as a proxy for cash, for how much cash you should hold, I think is fair to do in this presentation. And again, in the accumulation phase, I'd really be aggressive and I wouldn't hold any cash, as little as possible. But in the decumulation phase, the withdrawal phase, the more conservative you are, the more cash I would hold. The most cash I have for anyone is 10 years of money. But, if based upon the markets, if you have 5 years of cash and there's a stock market crash, you have 5 years for the markets to recover before you need to step into your stock-based or mutual fund-based investments. So, long term, the cost of cash was shown on that portfolio visualizer chart that it can be substantial, but I also would contend that the benefit of cash is that if you have a couple years of cash, it helps you be more aggressive with the rest of your portfolio instead of the 60-40 stuff and messing around with stocks and bonds in such an approach. If you had 5 years of cash in a money market fund and the rest of your money in stock funds, how would you feel? You might actually feel better than if you had a 60-40 portfolio, and I do have some people that feel that way. So I think cash and money markets can be a valuable asset to you if holding cash gives you the courage to hold longer term aggressive investments. So I hope this was helpful. See you back here next time. Thanks.